to White House, which has been a really nice journey. So let's jump right in. What I'm going to be talking through tonight, as mentioned, about 40% of it, 30% of it is stuff that you've seen before. It is necessary to set the scene, but I will be going into a lot of new detail that people who have seen a few webcasts or been around the traps in White House world for a while would never have seen before. Really interesting stuff, some great new research that we've been doing, and nice visual representations of it. Okay, so this is all about Bring On 2017. This is a really super early preview into where we think all the research is pointing us for good capital growth fundamentals, looking at current on-the-ground statistics to try and look at the crystal ball stuff, predict where areas might be going ahead in terms of growth more so than other areas. It may have been, you know, the tried and tested investment areas, the areas that we've been focusing on in 2016, trying to look forward into the next year, where are some new potential areas that are standing out. Look out in the next few weeks, I'll be doing a session like this around cash flow as your primary strategy, scarcity, which is low risk in, you know, close to CBDs, etc. High purchase price, lower yield in usual cases with a scarcity strategy, and renovation and development webcasts. So look out for those. I might try and make up a little bit of time. I'll get straight into it, guys. I'm just going to do another roll call, trying to migrate everyone over into this new webcast window. So I will pop things on pause just for a moment. Okay. Okay. We've still got about a quarter of the people or a third of the people that registered originally on the webcast that arrived and shown up that are still sitting there, actually haven't migrated across yet. So, yeah, I'm just trying to get everyone over. Thanks, Phil. Okay, I'm just, Thomas, I'm not sure. I think you can close the chat window. That might increase the size of your browser or the actual content window, if that makes sense. That might work for you. Just waiting for a few more people to come over. There's still lots on the first webcast, so okay, we'll just keep going through. What we're going to talk through is an end-to-end system. This is something we talk about a lot here at White House to achieve amazing things in terms of growth. And what I'm going to be referring to tonight is shooting for the stars is 25% growth in your first year. I've got a case study. I'll take you through a little bit about how a White House user has been able to do that for each of the first 10 properties that he's been able to purchase using White House. It is an end-to-end system. It doesn't just look at the suburb, it doesn't just look at the state, it doesn't just look at the property, it doesn't just look at the negotiation. If you bring all of the elements together in terms of your research, how you find a property, how you put it all together, making sure that each stage along the way is amplifying the growth into the next stage, you can achieve amazing things. This is what this system is all about. I'm going to break down each element individually. We have to focus out across the whole country, increasing our catchment area, making sure we get the local government area right that we're investing in, learning techniques and approaches to be able to do that. Which suburbs are primed for growth in that LGA? It is only usually 3 or 4 or about 10% of an LGA that is actual prime investment grade, leading growth forward for day one for when we're looking to invest. Which streets are primed for growth in those suburbs? The exact properties that are meeting the demand and driving up growth and rental yields in that asset class. How can you potentially negotiate and buy at or below value? All of that together helps us to achieve amazing growth as a system. Okay, so that's what I'm going to be breaking down tonight with a lot of new research, and this is in application to 2017. So, I suppose this is a bit of a stop and a bit of a check. How much, I suppose, would a system like this be worth to you? So just putting things in context, White House is for the DIY property investors. As opposed, it's research tools, it's software, but it's also a community of DIY investors who help each other. Not a buyer's agent, not a spruiker, not a developer, not a builder, not hidden margins, etc. This is a tool set. What we're going to be able to talk through tonight is something that you can take away as knowledge. It's in your head. It's something that you own then. How much would a system be worth to you if it could do this and it could do it over and over and over again? So these are just numbers, 5,000 traditional numbers you might associate with those services I mentioned before. No BA transaction costs, education costs. If you understand the different nuts and bolts of this system, how much will it be worth to you? I suppose just ask yourself that question before we keep going through. This website, no BS. Okay, I'm going to have to say that right now because I really try and always get to the absolute heart of the concepts, the theory, the research, and then relate it back to you guys, to logic, to common sense, to buyer behavior. That's what it's all about. It has to make sense. If it doesn't, let me know on the comments. They are live, as Phil's just mentioned. Please let us know. I want to keep breaking things down. If it's too subjective, then we might need to pull it out. If it's relevant to everyone, we'll take a deep drill down until it's crystal clear for everybody. That's what it's all about. I'm going to break this process down to you one puzzle piece at a time. You can take these puzzle pieces away with you. It is all common sense. It's all equally applicable whether you use White House, different sources of research, however you go about things. First key concept, for those of you that have been on a webcast before, I do say this and start with this each time. We do need to set the scene. First job we need to do to achieve amazing growth from day dot is increasing our area of interest, our catchment area. What I mean by that, so we have to look across the country for the absolute best growth potential from our first day of purchase. I'm going to go into some concepts around opportunity cost shortly. That will become a little bit clearer, but I want to talk about if you're only limiting yourself to investing next door in the same suburb that you've lived and grown up in. I started doing that. That was my first purchase here in West Hobart, just around the corner from where I grew up. That was my comfort zone. When you're doing that, you're exposing yourself to that market and only that market and the cycles within it. So you might be having to wait 5 or 7 years before you see any growth. You might be you're looking for cash flow, but that suburb is really only offering renovate for profit type upside. You might be pushing your strategy or preferred outcomes onto that suburb. What we're talking about here is increasing our catchment area so we open up the whole country. We look for the #1 growth market or strategic market for us as of that day. We might have a short list of multiple. They might be in Darwin, down here in Hobart, in multiple different areas. We can compare them apples for apples and find the absolute pinnacle of opportunity. That's what it's all about. It's about improving our comfort level, our research, our tools, acquisition methodologies to be able to purchase anywhere at any time to deliver us outstanding results. So how can we do this? This is the next question. Let me know if there's any questions at any time, guys. I'm just going to pop another link in the other old webcast view. We're slowly and surely getting everyone across to this new window. We're about half the way there by the looks of it. How can we do this? You might think, well, if we're going to look at the whole country and find the best opportunity, why don't we start with the state versus state approach? We might see is Queensland in the buying window, whilst Northern Territory is in the slowdown phase. And yep, once we land on Queensland, Queensland's definitely doing its thing. We can just go and invest in Queensland. Well, I have to sort of say that's not really the way of doing it. State level property clocks are far too general. Okay, so if you're going to think, well, Queensland as a state is at the right point in the property clock, it's in the right buying window for us to get growth, then that's too general. Regional, coastal, Brisbane, Southeast Queensland, you've got many markets going in different directions at different times and coming together to form an average state property clock. That's not really what we need to make our decision to increase our catchment area and our resilience. And generally they are just really storylines that you see in mass media. They don't mean much, they're just a headline. So we need to take a deeper dive. We need to open up our catchment area by looking at local government areas and the combination between local government areas where they are on the property clock and the suburbs within, the actual real opportunities, okay? So I'm going to pause things there. Let's jump across to Ripe House. I'm going to go into the state-by-state research. We have fully vetted this in preparation for 2017, okay? So this is, it's live information, live research as of today to allow us to make our decisions. So here I am on the Ripe House homepage. I'm going to click onto our dashboard. This is assuming that I've logged in. This is your daily launching pad into all things Ripe House. I'm going to load up the State of the States research tool. This is our first job. These are the 5 layers of research that we can perform here at Ripe House. Over here in the research tools, you have daily content coming through from over 30 frontier investor contributors within Ripe House. We have a no ads research and content news website called the Frontier Investor. It talks about research, it talks about how to manage large portfolios, how to purchase in the state, how to find property managers, legal issues, anything that you can imagine is covered off in property on the Frontier Investor. That comes through on your news feed. So much to check out. This is your daily launching pad within Ripe House. I have here clicked on the State of the States page. That's going to tell us where each state, as an average, is sitting on the property clock. I just want to probably make that point. This really doesn't mean much. Even though this page is sitting here, the property clock has a heartbeat against it. It is live. The state as itself is an average. So even though Queensland is sitting at 9 o'clock, that is an average. There may be parts of Brisbane that are already in the slowdown phase and parts of rural, coastal, as you'll see tonight, that are looking outstanding, 6, 7, 8 o'clock on the property clock for 2017. So let's use Queensland as our case in point, because that's going to be the first area that I'm going to be focusing on for outstanding growth potentially in 2017. Our next job is going into Queensland and finding individual LGAs that are between 8 and 10 o'clock on the property clock in the optimum buying window. That is our job. This is where you can really start powerfully and reliably increasing your catchment area and your resilience in doing that. This is the key. So I'm going to jump into that. One thing I did mention is there's no point looking at individual LGAs or states versus states if it's taking you 6 months to gather that data. It's not really good enough to do a once-off analysis of LGA versus LGA and then make decisions on that for 2 years. Our research has shown that it's only an 8 to 10 week period where the optimum opportunity to purchase in a suburban LGA is open. I'm going to break that down with some new information tonight. Live data is absolutely critical. We have to monitor LGAs to the day to be able to know how things are forming, where they're moving through the property clock, and when our optimum buying opportunity is. Because when markets get too much heat, you're competing against lots of other investors, less sophisticated investors. That's when that's where you want to position yourself before to be able to use those guys to generate your growth. So this is a new slide here. I'm just going to break down what I mean by the optimum buying window. So for many years, it might be that a suburb does nothing, a local government area does nothing. Okay, so that's the no growth area in the blue here at the start. In the left, no growth, opportunity cost. Okay, I mean opportunity, you're holding an asset without growth. You could have put it into another asset with growth, and the difference between the two in terms of profit is your opportunity cost. You need to position yourself just before the buying window or right at the beginning of it, within the buying window, to be able to see the stars aligning, looking at predictive methods of looking at or predicting growth. So metrics, advanced metrics that combine together, the stars align. How can you reliably see those stars aligning to predict imminent growth? Position yourself in the buying window just before it, and then growth occurs. It might be for 1 year, it might be for 5 years. That is the outperformance phase of that local government area. Lots of people moving towards the area, driving up rents, driving up growth. You've got investors being moved, attracted to the area. Lots of positive things happening. That plateaus and the cycle starts again. No growth. When I say no growth, I mean the suburb or the LGA might just be in line with Brisbane overall, but you're looking for these times when the suburb is outperforming the market, outperforming Brisbane, definitely outperforming Australia, definitely outperforming the Northern Territory as an example. So we're trying to position ourselves just before the stars align and the growth rockets off. Let me know if that makes sense. Yeah, I'll love to Amit's talking. We own all of our own data sets in it. We have been, like Google, monitoring on-market activity sold for rent activity for 5 or 6 years. So that's our data sets we own. We also have then bought and commissioned other data sets out to 15 years and monitor not just basic metrics like price, which doesn't really mean anything, but advanced metrics like sales volumes, days on market. We actually own data sets for 121 different metrics. Okay, so when you're talking about, yes, we go across the internet, like Google does as a search engine, monitor all on-market activity and bring it together, which I'll go through and show you. That allows us, when we do that, we're doing that within 8 hours for every suburb across the country. We are generating and regenerating all of the advanced metrics for suburbs, the suburb for street, suburb, LGA, interstate, dynamically every single day, going up the chain. So all of the information that you see is live. It allows you to make absolutely timely decisions, okay? That's the absolute key. None of this is necessary. If you're drilling down, the power of Lighthouse, which I'll talk through, is the individual streets, finding those streets that are moving forward as of now, not the dead spots. To do that, things have to be timely, have to be accurate, have to be live. Because no growth, if you hold a property for 1 day without it growing in value, you potentially have accumulated opportunity cost. It's all about minimizing that opportunity cost. If an asset's not performing, you are generating opportunity cost. We want to jump the gun. We don't want to jump the gun, potentially purchase, if you can think back, earlier on in the no growth phase and hold for multiple years. I've done that. Back in the earlier days, I've increased my resilience and my understanding. It's all about positioning ourselves just before growth occurs. And we're not talking about just any old type of growth. We're talking about outstanding growth. So as mentioned, we monitor predictive indicators. So it's not just one, it's not just one simplistic measure. I see this all the time in the media. It's not just tracking sales volumes and knowing that that has a relationship to growth. It's knowing how all of them combine together in different ways and in different combinations to form growth for different types of markets. We monitor things like public housing levels, things like owner-occupier to rental splits per street, per suburb, rents, incomes, all of these different things, ripple effects, distance to flood zones, lots of different metrics, 121 in fact, to then find combinations of those that are predictive in nature and have a link and correlation to future and imminent growth. It's all about trying to work out when that buying window opens and knowing exactly when it shuts. Just to probably re-elaborate on that, when a market is starting to move into a growth phase, so when it's starting to come up to that green growth phase, the buying window is closing. Even though there's still predictive measures in place to show imminent growth, you're now fighting against a lot of lower sophisticated investors. So I'm going to be spending a lot of time on this tonight in terms of the life cycle of a growth market, where you can be predictive in nature, you can position yourself in the buying window, that as growth is occurring, starts to occur and continues to occur, attention increases. More eyeballs move towards that market. The more eyeballs, the more those eyeballs and that interest is delivering you, the early adopter, the growth. But the further you leave it, the more people you're competing against, the more offers are being overridden, etc. We want to beat the heat. We want to use the heat to deliver us growth. Okay, that's the absolute key takeaway there. It's only an 8 to 10 week window. So think about other sources of research, potentially. Potentially other sources of research. It might take 6 weeks for that information to be gathered, to be collated, to be brought together, to be then dissected and a takeaway formed from it, and then collated and put into a report. And by that time that report is out, that is your window potentially is closed. It's absolutely critical to have this as a timely mechanism. Okay, so let's relate this back to what we're trying to do. LGA level research is optimum and is a great point to really find meaningful insight. Don't really look at the state, the city even, Sydney, when you say that Sydney is in a slowdown phase, it is once again a generalisation. Don't even look at the suburb. Sometimes you don't have enough sample size to reliably assess a suburb and what it's doing. You need to look at the relationship between the local government area, the suburb, the street, all the way through, to be able to be predictive in nature in a timely fashion. It's the interplay that is important. It's the holistic approach to property investment and research, okay? But it's all based on common sense. I'm going to break this down as well tonight. All predictive mechanisms are just trying to recreate buyer behavior and logic and common sense. So that's all we're doing. That's where we start. That's how we bring the metrics together. We use a bit of technology to do it easily, and then we give you recommendations, okay? And I'm going to take you through that whole process. Let's just do that right now. Before we go into the suburbs prime for growth, let's just use Queensland here as an example. I want to look for LGAs now between 8 and 10 o'clock on the property clock. So these are LGAs where the stars are aligning at an LGA level. Days on market are trending downwards, sales volumes are trending upwards at a high point in the cycle, yields have been trending upwards at a high point in the cycle, you've got population pressure, you've got building approvals are stable, you don't have a huge amount of supply coming to the market. You're not necessarily, I'm not talking about growth at all here, I'm talking about predictive measures. These are the simple ones, there's a lot more sophistication behind the scenes here, but we are generating property clock information for an LGA. You can also see that we monitor positive sentiment at the LGA and the suburb level. So the more mentions, the not higher the opinion score here, the more market heat there already is in the market. And it's interesting to see LGAs where this is growing. So one that was standing out to me here is Cairns. Cairns has been oscillating for about 2 or 3 years between 8 and 10 o'clock. It's had a few goes at a growth cycle. There has been some growth. Opinion has generally been building, and I think it's got a lot more run to go in opinion. Other LGAs like Moreton Bay is an example. Opinion's starting to move away from Moreton Bay. It's been 2016, a very strong market for investors to position themselves in now. The City of Brisbane is obviously scoring really highly, but it's interesting to see the transition up and back for opinion scores. Cairns is something, we're looking at the LGA here, but Cairns is an LGA that's really standing out for me with the interplay between the LGA and the suburbs. So I'm going to click on Cairns now. It's going to go into our Explore the Nation page. You can get to this via your dashboard, which is the Suburb Search Explore the Nation page there, the third layer of our research. This is going to load up every suburb in Cairns, and it's going to give us a mechanism of potentially comparing suburbs versus suburbs, apples with apples. Okay, and I'm going to talk through the whys of how we've got to this and why I like the interplay between the LGA and the suburbs within Cairns. Okay, might be worth branching off, Ben, in terms of Toowoomba. Interesting storylines with Toowoomba. There are certain patches, certain suburbs that look okay, but yes, as a suburb, as an LGA, things have sort of moved a little bit. When I say it's moved into the slowdown phase, it's patchy. It is not a really strong predictive story in Toowoomba. Different and conflicting storylines and buyer behaviour signals, if that makes sense. So Cairns, it's much more consistent and a stronger story. The metrics are not conflicting in any way. When you look at an LGA into suburbs, and breaking Cairns into inner unit market, tourism market, the growth suburbs in the north, the growth suburbs in the south, the growth suburbs inland with the shopping centres, etc., going in. So probably just had a bit of a segue then, I do apologise, but yeah, it's interesting to see. Sometimes you see LGAs and cities, in fact, standing out. It's the story that amongst the levels that really stands out and makes a sense to us. Okay, so our job really is finding the suburbs primed for immediate growth. I'm not going to reiterate it again. It's about getting them at that prime point in the buying window. We want to beat the masses and then use them to deliver us the growth that we need as a larger demand buying pool. We want to target suburbs that potentially have been lying dormant, the stars align, and then are set for imminent growth, and position ourselves before hockey stick growth. So more on that shortly. I'm going to skip through this. There's a bit of crossover. I just wanted to talk, we are trying to be predictive in nature. We're looking at buyer behaviour, why people have been attracted towards these areas. Growth is generated by large changes in demand that is not being met with supply. So just remember that it's really basic stuff. We want to use that demand to deliver us the growth. We don't want to be part of the demand because that's just going to move in the organic market. We want to use that large buying group to deliver us growth. When big changes happen in demand, big changes happen in growth. Generally, without looking at the supply side, we want to use those big changes in our favour. When that growth is then met at some point in the future, that demand, is priced in by increases in growth or is met with supply, that is going to happen at some point in the future, and that's when the cycle moves into the no-growth phase and the slowdown phase. When that demand starts petering out because prices have gone up or there's new supply comes in the market, okay, the equilibrium returns. That's when things transition to the no-growth phase and the cycle starts again. So we're trying to position ourselves just before things really shoot off. It's hockey stick growth. We're trying to position ourselves just before it. This is what it looks like. Someone who's been doing it reliably over and over and over again within Ripehouse is Guy Williams. Go over to the Frontier Investor. It's from your dashboard. It's the link up here in the top. We can see individual properties that Guy has purchased within Ripehouse as a full case study. Sorry, I've clicked on myself. Click on Anna Cooper. She is the editor of the Frontier Investor. She did a 4-part case study series on Guy, how he manages a large portfolio, how he de-risks interstate investment, all of those questions that you're asking Phil. He's an expert at doing it. He's an absolute guru on doing it. These are the individual properties that he purchased. You can see them all here on the Frontier Investor. This one here, what was it? Delacombe, 40% return in 7 months. 23% return in Salisbury. These are all going back into 2015, 2016. Average return for each of these 10 properties, annualized return is 25%. 105% cash on cash return, 6.25% average yield. So that's just an example of what is possible when you tie together all the layers of research and get them amplifying each other. That's what the key is. Okay, this is going to take a bit of a deep dive. I will go in a minute. I'm just coming back over to the page in terms of a breakdown and the rationale behind CAN. So I can go into that when I get into the suburb level. Okay. Drivers of hockey stick growth. So this is just a little bit of the buyer behavior underpinning of the predictive analysis. Okay. I'm just going to drop another reminder in to everyone to come across to the other web. Yep. Okay. Yeah, so this is the stars aligning. These are the stars. Okay, so you see increases in demand moving towards the local government area. So they may be infrastructure spend, public building works, universities, Westfields, IKEAs, business parks, population pressure. The government has drawn a big red circle around the LGA and said, we want more people to live here. So all of those things start occurring. It increases demand to live in the LGA, in the suburb, okay? So increasing demand. First thing that happens, people dip their toe in the water, they want to rent first. They rent, that increase in demand to rent drives rents up. Growth hasn't improved or growth hasn't started to occur yet, so yields also go up. So that's another predictive measure, rents and yields increasing. About 6 months after, people start going, oh, it's been great renting here, I'm going to start buying into the market. That's when you start to see sales volumes trending upwards. This is when the stars are really starting to align, sales volume trending upwards. You've got opportunistic investors like us looking at the rents and yields are now starting to purchase, driving sales volumes up because they are demand. Prices haven't moved yet. We've got a lot of value in the market. So sales volumes are trending upwards. Days on market, are they steady? Are they decreasing? If we've got lots of opportunistic developers already there, days on market may in fact go up with sales volumes. You see that happening. If sales volumes are going up, days on market are steady or decreasing, it means we've got stock tightening. And that is when the combination of things come together for growth to occur. This is a predictive buyer behavior stuff that is underpinned by our research. Okay? I just want to talk about all of these things happening. I'm categorizing those as metrics. Okay? So this is just a bit of an explanation around the Explore Your Nation page, because what we're talking about now, when all of those stars are aligning, you have a high metric score. So you can see the undercover strategy. You can see an undercover strategy has low opinion and sentiment. No one yet knows about it. It has low investor interest. It's not into the growth phase yet. It's not where the masses are coming. The metrics have started to really align. So it has a very high metric score. Great predictive measures for growth. That's just an undercover strategy. You have great income and high investability. Lots of properties on market, good discounting, nice ability to negotiate. Still, properties that you can find in the best streets, okay? This is an undercover market. This is when things are moving into our buying window. Then you start to see emerging into then a boomerang suburb, emerging and increasing sentiment. So the eyeballs are starting to move towards that market. The researchers are coming, the mass market researchers, the media are starting to move towards an LGA. Investors still haven't caught on yet, so potentially boomerangs, we've got a little bit of comfort level now because the word is starting to get out, but investors are turning their interest towards it. And when things move towards a big green, you've still got excellent metrics because you're having strong demand supply predictive measures. Even in the growth phase of a cycle, you're having all of that happening, but now you've got lots of eyeballs. Big greens, potentially your buying window might still be open, but it's probably closed or closing, and this is where you're writing it out for your growth, okay? I'm just going to re-elaborate. This is really in rough terms. You can't oversimplify them. Sometimes you have a big green over in the no growth or opportunity area, vice versa. But just in really simple terms, we're trying to see the transition between an undercover suburb into a boomerang into a big green. So generally, a lot of the big greens are still big ticks for buying. It all comes down to the one check and balance. It's really simple. Is a big green too late? Are you able to find properties on the market that are still have discounting, still able to call up and make an offer and have it accepted at a discounted rate? When you start making an offer and the agent goes, no, we've actually got 3 other offers on the table, or we've had an open home and had 3 offers from that day, that's when you can see that the big green has suddenly got too much heat and it's fallen off the other side of the cliff. So this is just a really simple example of how to really define the transition between the 3, and that's just giving a bit of concept and context to the Explore the Nation page, which I'll just go into now. So our job is finding within Cairns the individual suburbs right now with great demand supply, great predictive measures for imminent growth, but not too much heat, okay? So we want to be pretty sure of things. We want a little bit of interest, a little bit of opinion, but not too much. So Cairns has been one, whereas an LGA and lots of suburbs within have migrated between a boomerang and big green for about 18, 24 months, okay? So there's been investors coming in and out of the market, but then we have round after round of really strong predictive measures. So sales volumes keep going upwards. They might have a correction, but then they keep going out again, really keep breaking through new ground. You have growth periods and then plateaus and then growth periods again, even in that 24 months period. As I can say now, generally you've got a lot of really positive signs in Cairns, but you've got individual suburb markets that are undergoing the transition now from boomerang into big green. It's about putting ourselves in those key suburbs at the time we're buying. Very healthy suburb charts in an LGA, at an LGA level. If you look at random LGAs, a lot of them are small and red. Cairns are big and green or very healthy. But there's only really 3 or 4 suburb candidates, which I'll show in a moment. Basically means more than 150,000 residents in Cairns, over 50 suburbs. There's only 4 or 5 that pass all the ticks, only 2 to 2,500 dwellings. So it's only very small parts of these suburbs that actually tick all the boxes. We need to be very specific when we're investing remotely, when we're investing in these types of markets. So what I've done now, this was the Explore the Nation page that we left. This has loaded up every one of the suburbs in Cairns. It's given us a visual representation. So if you can think back, Smithfield is a very typical boomerang suburb. You've got high metrics, you've got building opinion, but you've got low interest. Income means good yields, low vacancy rates. Investability means good stock on market in the key growth streets, the sweet spot streets. Smithfield is an excellent candidate to be looking at. You can see the difference here with Parramatta Park, where the opinion has grown and increased and interest potentially is increasing. So not quite as healthy on the metrics, the predictive measures, but you've got a little bit more maturity in the opinion score. So it's interesting, Cairns North may have actually gone off the other side, so that metrics may have continued to decrease whilst there's a lot of interest and heat now in the market. So you potentially already had growth occurring in Cairns. So you can tell a lot about the shape. I really like the shape of Smithfield. It is a traditional boomerang, very healthy look. One thing you can do, so we've actually come into this page from an LGA. One thing that you can do is you can go, I want to know all of the boomerang suburbs at the moment across the whole country. And to do that, you can click on the tab, the toggle here on the left, and this will actually show you all of those shapes across the country. So more on that later. You know, this is how you can compare apples with apples in a very simple way. It's very powerful in terms of the platform. You can see here 118 properties currently on the market in Smithfield, current in-demand property, 3-bedroom houses, normal crime rates, high number of owner-occupiers, below average concentrations of public housing. So we're getting a bit of a feel for the suburb. 118 properties are on the market. You can see them all here. You can see that this property has been discounted by 4%. It's been on the market for 191 days, been discounted by 4% down to 215,000. So you can see the full listing history, how many days each property has been on the market. You can start seeing some blood in the water if there's been discounting, etc., that's been occurring. So more on that later. I'm just showing each of those red dots on the map relates to an on-market property. Darker the red, higher the price. And you can see the full listing history and property information there in a tabular format. We'll go into that in a little bit more details because our first job on that page is understanding the exact streets to invest in. We need to turn the screws. This is the key, as you mentioned, Phil, in terms of investing in these suburbs, as this is where Ripe House really started. We have to understand these markets as a local would, which suburbs are set to perform. We know those suburbs where we live because, you know, there might be new shopping centre going in, lots of owner occupiers improving their properties. People have been attracted towards a school area, not too far away from the school, but not too close, away from the public housing compound, away from the cemetery, away from the crime, away from the bikie hangout. We know all of those things in our local suburb. How can we look at metrics predictively to find growth streets that are going to really amplify our suburb level results? We've done all of the hard work. We've looked at all of the metrics. We know things like public housing concentrations per street, but we've also related those back to value, as you'll see shortly, and then also expected growth. That is the key, and it's a combination of those street level factors that can give us a growth. Streets are critical to get right, but they're often overlooked. They're a major component of amplifying our hockey stick growth. How major? This is we've basically been able to find 5 street level metrics that when combined can amplify your suburb growth by 21.9%. So what I mean by that, if the suburb goes up 4% in the same period, you could almost expect 5% growth as an average if you get the street right. In terms of Sydney, over the next 10 years, that potentially could mean $240,000 of extra capital growth based on current projections for Sydney. Obviously crystal ball stuff, but the really key takeaway here is the street is very important to amplifying your growth. What I mean, the sweet spot is under 15% public housing in the street, lots of the in-demand property types, so lots of houses, lots of 3-bedroom houses if people are demanding to live in those. It's not the unit compound of the suburb. Strong tenant demand. So this first growth cycle in the suburb is backed by tenant demand. We want to be in those areas that's really healthy for those guys. High rents, high yields, above average. This is where these rents and yields are driving up faster than anywhere else with good tenant demand behind it. It's usually only about 10 to 15% of each suburb. So across the whole of Cairns, it's only 2,500 dwellings. This is just a bit of a visual example of the effect of location, street location on value. So you can see here, proximity to transport, 1,100 square metres away from the closest transport hub is the optimum positive effect on value. While on the doorstep's okay. Proximity to schools, 250 metres away from your closest school is the sweet spot, and it drops off a cliff after 1,500 metres. Proximity to shopping is pretty steady out to about 1,200 metres. So this is just an example of how proximity to things affects value, but also growth. Because the really big one is public housing. Expect to pay 25% more than the suburb average if there is 0% public housing in the street, and 18% or more public housing in the street expect to pay almost 20% less than the suburb average. Dramatic effect on value and growth. Okay, I'm going to put things there because the suburb map analysis page within Ripe House gives you a huge amount of street level smarts. Okay, so you can see exactly where the public housing is located. The dark red patch here is dark because it's high in terms of the suburb overall, but it's only 7.7% public housing. Low, we can see that it's under our 15%, not an area to be concerned about. But we can see exactly where the areas of public housing are. We can see where the tenants and owner-occupiers live. So lots of tenants in the yellow area here, lots of owner-occupiers here towards the university. Lots of houses in the green, lots of units where the tenants are. So units and tenants go together. We can see where the higher for sale prices are. So exactly street level price guides, rent per week, and income yield, etc. What I'm going to do now, we need to find where the sweet spots are. Those 5 layers together. We're going to do this automatically using this tool. It automatically adjusts our tolerances. We can tighten up our restrictions. We can open them up if we like. Or we can click on the override here at the top, and that will default to our recommended street level areas. You can see it's only very small, 2 areas, 200 dwelling areas within this suburb that really stands out. We know that 3 or 4 bedroom houses are most in demand. We can see that from the View Suburb report, or when that blurb drops down at the start. I want to filter properties into those street level areas. I only want to see 3 or 4 bedroom houses as the market is demanding. And I'm going to apply that filter because we're now getting from 118 properties down to only the very small number that we are wanting to look at. So that's now brought it down to 24. We can see quite a few of these are already under contract. It's about 12. We do leave them on here when they are under contract because they haven't sold yet. They might come back into market. Technically, they haven't sold, but there's only about 12 of them that look to be on the market still. They are ranked in order. 400,000 is the first one. I might go into this one here at 420 because it might be a lot better property. It's already been discounted 4%. It's been on the market for 73 days. Let's click on that. You can see how we've got down to a very small number of properties very quickly. Before we go into this property specifically, I'm going to go into a few more concepts because our job now, remotely investing, is negotiating and appraising like a pro. It's all about doing that. We have to beat the heat, use those guys to give us the growth that we need, but we also need to be able to reliably assess market condition, comparables, the property value. We need to be able to leverage the information that we have, the listing history, the discounting history, public housing, the market, to be able to negotiate for success, potentially even buying under market, okay? Let's jump back across to this property because I'm going to go through, we don't have many images for this property. So Phil, remote investing, I'll get on the phone with the agent. I want to walk through. Please film me a walkthrough. I want to get on Facebook Live. I want to get on Google Hangouts. I want you to walk through the property. I want you to ask and answer the questions that I have for this property. This is a key because if you're getting into a market with the masses, with lots of lower sophisticated investors, the agent doesn't need to sell the property. It's already sold 10 times over. They're not going to do that for you. We are trying to get into markets before the heat. Days on market are still high and decreasing. There's still discounting on this property. It's potentially not a floor property, but the vendor is motivated. They need to get out. We are getting in before the heat, so the agents are more likely to be acting to sell the property and really hustle and potentially doing things like that. You've got insurance policies that you can take out in terms of building and pest inspections, using them as a second round of negotiation. So you've got the vendor over the line at 420, you get a building and pest inspection that brings back a few things. You can even negotiate based on that down to 405. The vendor has emotionally committed to selling the property and you're likely to even negotiate secondary. That opportunity to do that in markets that are really moving with lots of heat are very low, okay? You're not gonna have a chance. So that's what it's all about. The building and pest inspection is an insurance policy, third-party rental appraisals, that's your insurance policy around rent, yield. They can also highlight, they can be an on-the-ground inspection for you to highlight any tenant issues, little things that need to be fixed up, can really be your boots-on-the-ground resource. Lots of these little ways that you can employ to minimize risk and buy remotely. We are, remember, buying a commoditized type of property, so we're not going in and buying the only 5-bedroom house with a pool. There are lots of 4-bedroom houses in this market that are most in demand. They're turning over. They are commoditized. So we're just comparing apples with apples, and there's lots of choice, and there's lots of comparables to assess value. Okay, so we're not going in and being the exception, not the rule. We are able to assess value remotely far easier because we're buying the common type of commoditized property. This one, 570 square meters, condition has automatically been assessed as good. We can override that if we disagree with the software, the sentiment analysis. We have some really sophisticated algorithms that do this. Sometimes it gets it wrong. If it does, override it because it will learn from you and get better. In this case, it's going to condition this property as good. I agree. It's quite new. It's going to go away and find comparables that are more likely to be in a similar condition. You can see that on the 13th of October, this was discounted by 4% down to 420. We can really leverage that. We can potentially ask how long the property's been on market. Has it been discounted? Why has it been discounted? And we can really just come in now and say, look, what's going to buy this property? Is it 400? That's where you can start the conversation. If you know the discounting history, if you know the time on market. What it's doing now, it's going away and finding the 5 most likely relevant comparables. You can view the individual images and disagree if you don't think it's comparable. This one here is jumping out. It's far higher in price. We can view the images. If it is superior, you can remove it. If you're seeing another property jumping out, our job here is to own the process, to just see if a property is inferior or superior. If it is, take it away, because we want to get this range of 4 or 5 comparables nice and tight and very relevant to the property. In this case, there's not much variance. It's going to take away, it's going to average those 5 properties. It's going to give us that average of 460,000. It's going to have a series of adjustments based on the location of the property. If you can think back to those charts, that is all built into our appraisal engine. It's going to tell us that 430 is our final appraisal, asking price is 420, estimated rent is 440, estimated yields potentially 5.3%. We know this is on the market as distress. This is just opinion, by the way, guys. I haven't seen the property. I haven't even looked at any of the images. You take the time to do that. But we know the direction that the asking price has been going, and we can come in here potentially with a sneaky offer and purchase it. Obviously, this is just a really quick example. There's a lot of other options. I haven't taken the time to look at the comparables. The appraisal on this property might even be 400 itself. It's just for the purposes of illustration. Okay, but you can see how it all comes together. What you're looking for is amazing growth. I'll get to your question a little bit later, Lisa. I'll keep that there as a bit of a wrap-up or a negotiation. But what we are all looking for is amazing growth. I hope I've tried to break this down into a system that we can repeat, because it's all about really kicking up your investing and your portfolio to the next level. It's about taking the bull by the horns, looking at where the opportunity is, and arming ourselves with the ability to be able to do it. Whether that's research tools, the confidence and the systems in place to be able to really take charge and drive ourselves towards our lifestyle and retirement. The dreams, what are we achieving? What are we trying to do in property? Really taking ourselves towards that. I guess we've all said here, there's more to come, guys. I'm going to be going into some more details about another couple of markets we're shooting for the stars in 2017. I'll be giving you a bit more of a summary of those shortly. But I just want to say and take this opportunity to give a big thank you. A thank you for coming and joining us tonight. If you have made it this far, we're all pretty excited about property. We're all doing things together. We are all doing things for similar reasons for ourselves and our families. Based on this fact, I really do think Ripe House is optimized to us as DIY investors. It's a great fit for you. I'd love to open up a thank you offer as a subscription. We are available as an all-inclusive community of tools, research, and investors via an annual subscription. I'd love to say a big thank you and welcome you into the fold with a $400 saving for tonight only, bringing our annual subscription down to $1,197. Everything you've seen tonight and a lot more, which I'll go into in a few moments, is included. Nothing is left off the table. It's all about empowering ourselves to make decisions to give us absolutely outstanding results. And I'd love to bring everyone into the fold together with this offer, because it's only available until midnight tonight. How to lock it in? HTTP, we can cut that out. Just start with the www.ripehouse.com.au/bonus. That is where you can go right now. Click on the Get Started button, enter in your name, email, phone, click on the subscribe button, your credit card details. Incredibly secure. It's processed by Stripe. Your details are sent directly to them. We don't contain that. They process the transaction. All of your account is then set up in your welcome pack, and email, etc. is all sent out to you with your login details. It'd be really great to get you on board. I'd love to get started together with you. That's why it's expiring tonight at midnight. Let's jump right in, because I am also seeing, this is the more research that we're seeing in 2017. Lots of you. Sorry, Tom, about the late night. Good luck getting up at 4 a.m. We'll be sending a recording out, Tom, by the way, which you can get into. The next areas that we're looking at, so Tiana, please forgive me if I do pronounce that incorrectly. Tiana, we did look at South Australia. Things are not really, they're a little bit confused in South Australia. So there are some interesting suburbs. We do have a couple in our boomerangs, in our big greens. We have been, and recently did a webcast on Adelaide. South Australia is looking okay, but there's no major drivers of demand and major bringing together of the stars aligning, if that makes sense. WA obviously has gone through a real low point, a really long period of slowdown. We are at the absolute rock bottom low point, and things potentially are starting to align and emerge from that low point. Not to say it might, we are just noticing and monitoring at this point, but it is starting to feature quite heavily in our boomerang suburbs. So not with a huge amount of proliferation. We don't have, there are a number of LGAs, but not a huge amount of suburbs within those LGAs that are really looking strong. So it's still a little bit patchy, but it's worth taking notice and monitoring throughout 2017, because we might be able to get in at the real start of the buying window, negotiate very hard, and position ourselves for the masses to come along and deliver us growth. It's only going to happen, when things are moving through a property clock out of the slowdown phase. It's only going to happen in a very piecemeal approach. Then things, as they move towards boom time, like in Sydney, it's literally every suburb that is doing good things. As things start transitioning, it's very patchy to start with. We are seeing more alignment happening in WA, and it's starting to feature quite heavily in our boomerang. So watch out for that in 2017. Next area, regional Victoria. This is a big tick. This is really strong alignment. It's already been happening in 2016, but it's increasing in 2017 by all of our indications. We're seeing lots of regional Victoria aligning together, similar price points, similar reasons. Your Ballarats, your Bendigos, your Moes, regional Victorias. Geelong is already a lot of heat. Geelong is already big greens. We have been, it was an undercover at the end of last year. It was a boomerang for the first, a lot of suburbs were a boomerang for the first half of this year. Now it's a big green, the word is out. Lots of other researchers and experts in the industry are now on board with Geelong. We can really hang our hat on being one of the first, if not the first, major recommendations coming through for Geelong. It's now a lot of heat. Already been really good growth, particularly through medium to lower socio areas. A lot of people trying to invest there now from across the country. Look for that to continue to proliferate throughout 2017 into smaller regionals. But we are looking at government policy at a state level, changing the state and regional centres together. So, infrastructure, private and hospital, school, and gentrification coming through these regional centres in very similar ways. That's probably the point that needs to be made. So that's our other big watch for 2017, if that makes sense. Let's jump right ahead. I just wanted to summarise again before we get into Q&A. I do really apologise about the technical difficulties tonight. A little bit of a late start. The software, I'm not sure if it's good or bad. We'll have to take some feedback. But I just wanted to reiterate the points before we get into our Q&A session that Ripehouse is a community of DIY investors. Together, we are designed to help and empower using technology to really move us forward. It's about learning together. We have a learning centre with lots of resources, FAQs, videos, tutorials, research reports that come out monthly that guide us for our strategy. All tonight is about is how to use Ripehouse for capital growth. We are equally applicable for cash flow, renovate for profit, scarcity low risk strategies and development. We use the software differently. Watch out for webcasts coming up in the next few weeks for previews of 2017 in those regards. But we are all about coming together and helping each other. So we have live phone, chat, and email support integrated on the page. We're there to support you. Myself and staff are experienced investors. We can do that because I just reiterate the point again, it's designed to help. Research, technology, tools out there. We are always trying to improve ourselves because it has to help us. If it doesn't, we're not moving forward. So lots of other people use Ripehouse. We are growing really quickly. It makes me really proud. It really makes me proud to listen and hear from other investors who are doing really good things, but also other researchers, educators, buyers, agents in the industry using Ripehouse in different ways. Okay, so it's already out there. It's already been used really well. I just wanted to reiterate this thank you offer once again, because it does include absolutely everything. Usually we charge $97 for our monthly reports. It includes them all for free. This thank you offer includes $400 saving on the annual subscription, but also all of the paid research reports, private webcast events, private group coaching. All of it is included because we are doing this together, okay? We are trying to give you everything that you need to be able to purchase successfully for amazing results. It's over $1,800 in bonus value, only available till midnight. Jump over to www.ripehouse.com.au/bonus. Hit on that big red Get Started button. Enter in your basic details. We'll be ready to go. It'll be great to start working with you together. I might put things on pause there for a moment, just a few moments while I go to and start the questions coming through. If there's anything you'd like to ask, now's the time. I know we've gone way over time, so if you wanted to contact me personally, jacob.field@ripehouse.com.au, so I can get back to your questions. You can't stick around, it's too late. Whatever it may be, that might be an alternative. But if you'd like to ask any questions now, is the time. I'll gather the questions up. I'll take a few minutes for them to come through. It'll be great to keep the conversation going. Happy for it to be as long as it takes. If you don't want to stick around though, you've been able to take away some learnings, some new ways of thinking about property. Noted down any of the research. There will be a recording coming through tomorrow. You can take that away with you and use it as a reference material. Don't want to stick around. Thank you for coming and good luck in property coming into 2017. Okay, I might start with these. Thank you, Matt. Thanks for the opinion. Data sets. So, Amit, opinion. Really interesting one. 2015, 2016, I spoke with almost 100 experts in the industry. What I meant by that, so Real Estate Institute members, Malcolm Gunning, who's a contributor on the Frontier Investor, John Cunningham is now Real Estate Institute of New South Wales president, talking about New South Wales. So when an expert can talk about the state overall, I normalise that information. I ask them which areas they think are prime for growth and the methodology behind it. I'll then drill down to individual experts in LGAs like buyers agents, valuers, and then also national researchers. So a lot of familiar names, a lot of people in the industry who I have developed relationships with over the years. That enabled me to normalise methodologies that people use time and time again and areas that they're looking at to form a baseline for a score for an LGA. That's all media mentions, property media and mass media. We are generating opinion scores. That is now normalised and updated routinely. Looking for positive sentiment attached. We have algorithms that monitor that and attach opinion scores, positive opinion scores per suburb, per LGA. Yield is one, which is just a derivative of gross yield. So rent per week versus suburb price. We are monitoring that over time. It's the trend that is the key, but you also then we multiply. So the income score, as an example, is looking at yield, and we have an algorithm that looks at the strength of that yield, the reliance on that yield, because there's no point having high yield of 15% if you've got 350 days vacant. It's a combination of the two. Things like public housing data sets started with ABS 2011 census. That's obviously completely inaccurate now. So we, and my team and I, every 6 months, we go through LGA to LGA, look at LGA policy. Have they sold down public housing enclaves? Have they created any? Can we update the street and suburb level LGA public housing data manually, which we do. Obviously, we've lost a bit through the nets over the years. We think the plus and minus is currently sitting at 3.5% public housing per street. So you're just thinking if it's 20% public housing from our perspective, it could be plus or minus 3.5% on that. But we consistently update our data sets. Other data sets like crime per suburb, we can get it down to a street level for some states. For some other states, we had to come down to researchers, academic sources here in Tasmania to get crime which affect property to a suburb level. So we're changing our data sets. We're moderating and updating and owning all of our data sets. The importance there is looking for the combinations of them together. So those 121 metrics, we've actually got a whole other webcast that we could go through about how we combine those to be predictive in nature. Yeah, so it's about finding the combinations. Peter, around Hobart, I might just grab that there. In terms of, yes, opinion investment, we've been talking about Hobart, the buying window was firmly open. End of 2015 into 2016, there's way too much heat down here now. You've got really low sophisticated investors, the masses buying into the market. You're competing against a lot of others. I do believe, even though we're probably 1 year into 3 years in terms of a growth cycle occurring, so you're likely to have continuing strong growth. You're competing against a lot of other investors down here. I think the opportunity to purchase is a lot better in other areas compared to Hobart. So I'm not saying we're not going to have growth going forward.